ready to start. So I appreciate everybody's got a lot to do, and obviously time is definitely precious. So we'll make a start, and we'll move forward. So I suppose, yeah, good afternoon, everyone. Welcome to the webinar today on the topic of credit and the potential impact on the recruitment sector. Today's webinar is brought to you by the Giant Group, a leading contingent workforce management company for over 30 years. Over the next 40 minutes or so, we'll focus on the potential impact of increased requirements of credit throughout the contingent supply chain. As ever, by doing a number of these webinars, we expect there to be lots of questions. So please send them via the Q&A button, and we will leave time towards the end of the webinar to address as many of these as possible. Today's agenda and areas that we will cover will include credit within the contingent supply chain, credit options, what the potential risks are and how you/Giant assess the risk, and also the cost of credit. Today's webinar is hosted by a number of experts here at Giant Group. Firstly, we're joined by Chris Walsh, who is Giant's National Sales Manager. Chris has been within industry for the last 7 years and is supporting recruitment agencies and hirers with management of their contingent workforce. Chris is responsible for the growth of our SME account base and manages a team of regional business development managers. We're also delighted to be joined by Alison Small, CEO of Giant Finance Plus. Alison heads up our Giant Finance Plus business, which provides invoice finance, branded systems and payroll services to the recruitment businesses across all sectors. Alison has 30 years experience working in the banks and finance sector and helps businesses create robust cash flow strategic for growth and resilience. And myself, Michael Howard, head of agency sales here at Giant Group, having worked in the industry for 13 years, helping agencies navigate through a variety of legislative changes to ensure compliance and maintain profitability. I oversee and head up our agency sales team to ensure our recruitment partners have access to the full range of Giant Group's services. And finally, we're also joined and supported today by Betty, who will help support on today's webinars with the data and the slides, as well as gathering information for our Q&A analysis later on in the webinar. So just a little bit of a summary for today. The format for today's webinar will be for myself, Alison and Chris to address a number of specific areas that involves credit being utilised throughout the contingent supply chain. As always, please make sure you use the Q&A button if you've got any questions that we will pick up towards the end of the webinar. Good to see a further number of people have attended, and I think we're ready to go now the introductions are complete. Chris, good afternoon. We'll come to you first. So if you could talk about the credit within the contingent supply chain, covering the background and also the impact on credit, please.
Yeah, okay. Thank you, Michael, for the introduction, and thank you for everybody joining us today. So we'll get right into it, really, given a broad spectrum overview. So we know that the current base rate set by the Bank of England is 5.25%. This is due to continuing inflationary pressures, and it's currently the highest that it's been since August of 2008, the year of the financial crisis. As recently as March 2020, the base rate was as low as 0.1%. So what has happened? Several factors have caused the general price level to rise. The UK and international trading environment as a whole was already feeling the pressure from demand rising as COVID restrictions eased. This, coupled with supply chain weakened by large parts of the economy having been shut down for so long. Catalysts such as Russia's invasion of the Ukraine have intensified this pressure and caused the prices of energy, food and other goods to rise sharply, contributing to the hike in inflation and triggering a cost of living crisis. We've also got ongoing and expanding conflict in terms of global economic uncertainty. This is being created primarily with the rerouting of cargoes from the Suez Canal, and is creating further strain on supply chains with sharp rises in commodities already being felt internationally. So an increase in the base rate has a direct influence on interest rates, which will in turn have a big impact on the finances of businesses. Rising interest rates affect businesses through several channels, Firstly, it can affect their top line. So slower economic activity is likely to lead to lower demand for goods or services. Businesses are reluctant to further operate on credit due to the increased interest rates, and businesses with cash reserves will see a wealth effect of higher returns, yet these interest rates have not yet caught up with rising prices. Secondly, businesses will face higher borrowing costs, further eroding their margins. And lastly, even if businesses are not impacted directly, they may still experience second-hand effects due to the increased prices of goods from suppliers and will be forced to increase their own prices and/or face supply chain disruptions. This could push inflation even higher, further eroding sales. So importantly, what's the impact on the UK economy? So the construction sector remains the most significant contributor to insolvency, representing 17% of all insolvencies in 23. There were 25,158 registered company insolvencies in 23. That's up 13.7% from the previous year. Company insolvencies in 23 reached the highest annual total in 30 years. The figure includes 20,577 voluntary liquidations. That's 9% increase on 22 and the highest number since the series began back in 1960. So with buffers waning, most vulnerable corporates and sectors have been caught between a rock and a hard place in 23. Excess cash at non-financial corporates remained high in the first half of the year, but this cash buffer remains highly concentrated in the hands of large firms and in specific sectors, primarily tech and consumer discretionary. At the same time, net cash positions are dropping faster than economic activity. The exceptionally high figures in 23 reveal the multiple pressures on businesses as the economy stagnated last year while borrowing costs surged. Wages rose, and according to numerous sources, this lay bare the challenges facing companies amid slowing demand and high production costs. So let's look at trade credit insurance claims last year. So 9,671. This is the number of new claims received by ABI member trade credit insurers in H1 of 23. That's a 54% increase compared to H1 of the previous year. 101 million. So this is the value of payouts to support clients hit by non-payments. That's up 23% compared to 22 and is the highest first half yearly amount since 2018. Construction and retail sectors have borne the brunt, including high-profile insolvencies such as Henry Construction, Wilko, and Buckingham Group Contracting. So Buckingham Group Contracting, looking at this as a bit of a case study. So we provided financing cash flow to recruitment agencies at Giant for placements with Buckingham Group via the supply chain. This was through Giant Finance Plus primarily. The agencies affected by the sudden collapse of this clients were covered by our insurances for their incurred losses. We also know that there were a number of recruitment businesses who had trade credit in place with the Onward umbrella supply chain, in which insurance may have protected the umbrella company against the agency, but not the agency against Buckingham Group, the end client. The differences between trade credit and financing cash flow, Michael will run through in detail shortly, but it's a key point to always know who's insured with the different credit options in the supply chain available. So as we look forward, what's the outlook for 24? So corporates' liquidity positions are worsening fast and prospects are not likely to improve before 25. Corporates are also not getting additional relief from commodity and supply chains, while labour costs remain a constraint for a majority of them, mainly for consumer-driven services and construction. UK corporate insolvencies are set to pass 33,000 this year, exceeding the 25,000 total in 2023. In the context of the looming deterioration in payment terms, we don't expect any significant changes in insolvency frameworks to occur in the next 2 years that would reduce business insolvencies. So importantly, what's the impact again on the recruitment sector? So first of all, it's looking at talent. So higher layoffs have led to risk-averse talent. So the layoff rate rose from 6.9% to 8.3% during the first 6 months of 2023, while hiring volumes fell 11% between Q4 of 22 and Q1 of 23. At the same time, voluntary terminations, as contingent workers proactively leaving their assignments, declined 24%, between Q4 of 22 and Q1 of 23. The white collar market, so IT, technology, finance, is a key client base for Giant, felt the pinch in 23 because in terms of new contractor setups, this was much lower than experienced in previous years, and again is a direct result of the impact of the wider economy on the contingent recruitment sector. So technology in the IT sector. So hiring freezes were common in 23. So we all know tech giants, including Amazon, Meta, Alphabet, we've seen in the news, were laying off thousands of staff starting in late 22 after a pandemic hiring spree. The collapse of Silicon Valley Bank, a key funder for tech startups globally, caused further shockwaves across the sector. Businesses quickly became more conservative with the hiring strategy for 23. Activity in London and other regions was as a result much more muted compared to 22, as end hirers also faced pressure from continued high levels of inflation discussed previously. The acceleration of recruiter layoffs. So with markedly lower demand for permanent employees and contingent workers, businesses of all sizes needed to engage with fewer recruitment firms. Give me a second, I've just froze. Sorry, just go back for me, Betty. This reduction is an opportunity for recruiting functions to call out many of the weak recruiters that they were forced to hire during the 21 and 22 talent shortages. This means that many recruitment businesses have retained their best talent, but as they look to grow again in 24, they will need to rehire to capitalise on the uplift in demand for contingent workers this year, a costly exercise. So what does all this mean and why are we talking about this on a webinar today? So we've seen a marked increase in the demand for credit. Over the past 18 months, this increase has been huge in terms of the demand for credit from the recruitment sector. The cost of borrowing has increased exponentially at a time when resource requirements and candidate placements have fallen. Payment terms have also been extended down the chain from end hirers, suffering the same economic effects as the onward supply chain. We've seen the impact felt at MSP, neutral and master ven levels, which has then flowed down to the tiered agencies supporting resource below. Similarly, employment businesses supplying directly have felt the strain of increased payment terms too.
Thank you. So it's over to me. I'm going to be talking a little bit about the overview of the credit market, but just want to say welcome today and thank you very much for joining. And thank you, Michael, for the introduction and for Chris for that very good overview on the economy and what's happened. As we can see, it's been a bit of a busy time over the last couple of years. And we have entered a period that's very different from the last 16 years where we had a kind of benign economy, low cost credit, and therefore money wasn't quite valued quite as much as it is today. So you've got a bit of an overview of the credit market here with just to mention about the insolvencies that I think Chris has really covered, but all the sectors showed growth over the last year, and growth not in a good way, the insolvencies increasing. And in store, there's particularly some issues there for some sectors such as continuing construction, hospitality and transportation. One thing that's just important to say before I move on to the detail that I'll cover today is that cost of money has increased for everybody. So people who are making decisions on trade credit, their cost of money has increased. Even if they don't have to borrow to provide that trade credit to businesses, they have an opportunity cost. So they could be putting that money into the bank and actually getting a return over a mid-market money rate of 5%. So that's increased. And also for finances, a lot of banks and financiers need to actually access credit in order to provide credit on an onward basis in the supply chain, and that cost has increased. So now more than ever, it's really critical that businesses look at ways to access credit and have a robust cash flow strategy going forward. So my first message is, yeah, Betty, that's fine. My first message is cash is king. So managing business cash flow, the money flowing in and out of your business is essential for business health. Profit is often the focus of business leaders, quite rightly, but without strong cash flow, businesses can encounter financial difficulties and distress. And strong cash flow builds business resilience. We particularly saw in our portfolio that businesses had good reserves and had strong financial relationships with their finance provider, and also had accessed long-term trade credit partnerships, performed much better and were resilient during the pandemic. So we look at Giant Finance Plus of helping clients set strategies for robust cash flows. So how can businesses improve their cash flow? I like to look at it in three ways, really. You've got the operating cash flow, which is a trade credit, which is your daily cash flow, your money going in and out of your business on a day. This is influenced by how long you give your customers to pay you and how much credit you can obtain from your suppliers. The other side of things is financing cash flow, which is debt and borrowing. And that's really from banks and financiers, overdrafts, term loans, invoice finance. And again, we'll talk about the differences of those a little bit more, but that's another way of achieving a better cash flow. And then the final way is investing cash flow. And that's when you could look at your own funds, your family, your friends, private equity. There's some good recruitment specialists that like to share in equity, and they can provide not only money, but useful advice and contacts. That's sometimes thought of as perhaps diluting your equity, which of course it is, because people do expect a return for that, but actually it could have a bigger pie. So it might be something to look at, but we're not going to focus on that today. Today, we're going to look at operating cash flow and financing cash flow to improve your credit. So operating cash flow, the basic rule is simple. Make sure your outgoing cash is less than your incoming cash. So there's two sides to this. Speeding up debtor and customer payments, and that's depends on lots of things, but really the terms you give and also your paperwork. So we'll come on to that in a little bit more detail later. And slow down your creditor and supplier payments. So again, that's asking for time to pay, which is terms, and credit, which again, we'll talk about a little bit more detail. So businesses can do this by cautiously giving trade credit and by accessing trade credit from suppliers. Now, the cost of capital is actually really important to be aware of, because as we've heard from Chris, interest rates have gone up, and in my view, they're unlikely to fall significantly. I think whilst we feel it's an unusual period of time at the moment, if you go back to 50, 60, 70 years, you'll see that the last 15 years have been very unusual for interest rates. So I think it's probably worthwhile planning for the future for interest rates to be not significantly less than they are now. So one thing that we talk to our recruitment clients about is don't ignore the fact that if you're giving trade credit to your customers, how much of the margin that takes. So if you've got a base rate of 5.25% and say an average margin of 2.75, that means an averaging borrowing cost of 8%. If you look at that of your cost of trade as a percentage of your trading volume, so by that I mean you take the 8%, divide by 365, the amount of days, times by the amount of credit you're giving, then you'll quickly see that you've got 0.67 of your margin goes on 30 days credit, 1.33 on 60 days credit, and 2% on 90 days credit. So it's really important to think about how that builds in. And we are beginning to see that in price rises, but I don't think we've seen the that wash through completely as yet. So just a little bit on the trade credit cycle. So understanding trade credit helps you understand both what terms you'll give to customers and how your suppliers will look at how they give you terms. So the trade credit cycle, I think everyone will know this, but order received, checking the terms of trade, obtaining insurance, making sure that you have trade credit or supply finance in order to meet those demands, and supply the services, invoice and collect. There's a few things on the right-hand side of this slide that I'd really like to talk about and point out. The first is credit checking. There's several credit reference agencies out there, Dun & Bradstreet, Experian and Credit Safe, and all are really worthwhile making sure that you have some access to, so that you can check the customer creditworthiness of the people that you're supplying to. And don't forget maybe old-fashioned trade references, because actually speaking to people who've worked with these customers actually will really help you ascertain how quickly you should get paid. Credit insurance. Chris has talked about credit insurance and the big increase in claims. The credit insurance market is so important to trade credit all the way through, and it's really, I'd urge to kind of keep close to what they're saying and what they're thinking, because it will give a really good idea. But actually, it is a very good market. It's well served, and cover is available from insurers for trade credit. Other financiers, specialist financiers like ourselves, do provide trade credit as part of the package, but you can also access trade credit yourselves. Terms and conditions. Try to stop any friction in the payment process. And by that, I mean reduce the possibility of dispute by being really clear. Terms and conditions, when people will pay, what the obligations are. And just one thing that I think not everybody is aware of, but credit insurance doesn't cover a dispute. So it's even more important to get rid of any possibility of dispute out of the supply chain. Just a word on intermediaries. And by this, I mean managed service providers, neutral vendors. Sometimes it can be quite hard to see who the end hirer and who the end payer actually is. And one question that we always ask is, who would you sue if payment didn't come in? So just have a look at that and make sure that you know the actions you would take to recover. Most of the time money comes in and that's fine, but if it doesn't, what actions would you take? And then just a final note on export. A lot of our clients are looking at international possibilities of a way to grow, particularly as the UK's just reported, stagnant growth, recession. And therefore cover is available if you're exporting or transacting with overseas. So please just bear that in mind. And just a final point before we move on. Sometimes we think that credit insurance is an expensive option, and particularly if the margin is low and the gross margin is low, but actually it's when the gross margin is low that actually you can't afford to lose that. Therefore, credit insurance becomes much more important. On the other side of the coin, trade credit, how do you go about maximizing your trade credit with your suppliers? Well, the slide that I just covered is the inverse of that. So hopefully if you're looking at things and how you give trade credit to your customers, you'll be able to understand and stand in the shoes of the supplier and how they look at providing trade credit. But most suppliers want to reduce the risk of default, so they'll ask for credit insurance to cover the balance. And by suppliers in recruitment, the system suppliers, but labour supply are obviously a very large part of that. The British Business Bank, which is part of the government, gives some really useful tips to help improve your credit score and hence gain better insurance. So these are things like make sure you file full rather than abbreviated accounts at company's house, pay bills on time, keep within finance limits, keep personal finances healthy because there can be some cross-checking. Only apply for credit to get a hard search on your records when you absolutely need it, because it can actually affect your credit score. And then collaborate with suppliers. If you have a really good working relationship, ask to give feedback, and particularly a lot of AI platforms are out there at the moment sharing payment information, and sometimes they ask if you'll share your information. It might feel a little intrusive, but actually it's quite good to share that payment information because it can increase your credit score with credit reference agencies. So that's a little bit about trade credit and how you go about that. So moving on to financing cash flow. Most businesses have to pay bills immediately, and customers take on average up to 50 days to pay. So trade credit rarely meets all the cash flow needs of a business. And I would encourage people to have a strategy that covers trade credit and financing. Best not put all your eggs in one basket, and make sure that you've got a good coverage. So financing is met mostly from invoice finance, overdrafts or loans. People may be familiar with those, but just in case people want a definition of them. So loans tend to be reducing in nature, so that actually is paid back over a period of time. Overdrafts and invoice finance are revolving credit facilities, so they kind of continue to revolve and therefore don't get paid back as such. Overdraft tends to be much shorter term and only in case of need, and invoice finance is a longer term committed facility. These are generally provided under clear terms and have security attached. So unlike trade credit, they have security against business assets. So they extend beyond the credit rating of the agency or the recruitment business, and they go to the end assets, which will be, in invoice finance case, the debtors, the invoices that have been raised. They can sometimes extend to personal assets, and particularly overdrafts and loans for banks tend to sometimes look at houses, so be aware of that. And check where those where that extension of the finance tracks to. What does this mean though for the financier? Well, generally it means that they have a better position than a trade creditor. Hence, they should be able to advance more for longer and feel more comfortable extending with you as your business grows. So in a default situation, in an insolvency situation, we hope that never happens to any of the businesses that we're talking to, but actually the provider of the finance gets their money back before the trade creditor. And hence, really, over time, the finance option should be cheaper than trade credit, but at the moment, we're not necessarily seeing that. One thing I would say is that because banks and financiers and are finding that their cost of credit is increased, the supply of credit is really tightening. And UK Finance reported that in Q3 2023, the supply of credit to SME businesses in the UK has actually fallen from 4.4 billion to 3.5 billion. We don't quite know if that's a demand driven or a supply driven, but it will be yet to see. But one thing I would say, because the supply of credit is tightening, having committed partners and that strategy, balanced strategy between trade credit and finance is an important one to consider. So just a little bit more on invoice finance. Invoice finance, just as a definition, is where a finance company purchases invoices, they pay on day one, and that allows money to be provided to the company, and then the invoice finance is repaid by the customers who are advised and instructed to pay them, and then the cycle continues. Really, it's a financing that speeds up your operating cash flow. So there's a good market demand. There's approximately 35,000 businesses using invoice finance, receiving 20 billion in advances to support recruitment and other sectors. Recruitment is a very popular sector in invoice finance. And the reason it's popular and it's a good market supply is that it's got really good, strong book debt. I'm sure you'll know this, backed by good paperwork, online timesheets. So it is a market that is well served. One of the things that is important, particularly as the cost of credit has increased, is that people consider getting more than just finance. Bain Management Consultants did a really good survey last year saying that actually as the cost of credit's going up and people are becoming more discerning about their finance provider, it's much more important that the finance provider helps with jobs that are done as well as just providing credit. Recruitment specialists are particularly good at that in this sector, making sure that they provide more than just finance. And then finally, because we are still in a very difficult time, sorry, Betty, just one back, haven't finished on the final one on that. Finally, on the choose your supplier carefully. We're in a challenging time, so make sure your financier is financially stable for you and that can grow with you and provide you the levels of finance that you need over the longer term. And then finally, my last slide. So just on the right hand side, we've got the cost of credit. We can see it's exponentially risen, and reiterate that I don't believe we'll be looking at the left hand side again for a while. So having this built into plans and strategic plans for companies is important. There's some pros and cons of debt and trade credit just for me to finish off on. And really, I suppose the first one's cost. Sometimes it's seen as a low cost option, but actually it's often built in to the pricing, and if you've got trade credit, it'll be built into the pricing, or potentially if you actually don't get trade credit, you could actually negotiate lower prices. Trade credit can also be easily withdrawn, and debt finance is more committed and stable for the long term and governed by clearer terms and conditions. The main one for me, though, is that finance tends to grow, particularly invoice finance tends to grow with the client, with your business growing, whereas trade credit does stay pretty static. There is always a delay as well in your credit rating. So you may have done really well last year, but it takes 6 months, 9 months to get the accounts filed, and therefore your credit rating may not go up. That's when things like financing comes into their own, because they can support you during that time. So the suitability, one's more for the short-term needs or long-established relationships that you can rely on, and debt finance is more suitable for your long-term stability and growth. As I said, we recommend a combination of them both. So hopefully that's given you some insights into debt and trade credit, and I'm going to pass back to Chris and Michael.
Thanks, Alison. Yeah, thank you for such a detailed overview on the differing credit options available. Just a quick reminder to everybody who's still with us at this point to please submit any questions using the Q&A option, and we'll endeavour to get round to them all at the end of the overview. So moving on to you, Michael, what are the potential risks, and should agency partners and Giant assess the risk in differing manners?
Thanks, Chris. Thanks, Alison. Yeah, so I suppose to summarise, there's two ways that businesses can get any sort of form of credit or finance. That's trade credit and debt finance. And I think it's also a topical point is what Alison briefly covered on, which is the level of uninsured debt that we currently see at the moment. So I'll start on with trade credit. And this is becoming the most common type of credit used within the contingent marketplace. Historically, working in this sector, PSL statuses have been a requirement for compliance, accreditations, and timesheet rebates. But I think nowadays, given the detail from Alison and Chris, we can see that the cost of borrowing money and the cost of providing money ahead of you receiving it has gone up exponentially. So the requirement now with a lot of recruitment agencies that potentially are on this webinar today is that you will provide trade credit to us as a business partner. That has become a really, really big focus in the number of businesses that we currently support and would look at supporting in the future. In terms of Giant, we do have a number of commercial relationships with recruitment agencies that are using this type of credit to help with increased working capital. As Alison and Chris have mentioned, you know, they can reduce the cash flow that they may be put on in terms of 30, 40, 45-day payment terms to support a client. They can leverage some, most, or all of that working capital on the enhanced increased supply chain, and likely to be with umbrella companies taking the brunt of that going forward. Here at Giant, we have a number of commercial relationships on the trade credit side with recruitment agencies. We do have a different process for both private and public sector end clients and end hirers. Clearly, we have to review the financial stability of the recruitment agency that we're going to be in contract with. But if we get involved in the medical sector, for example, and we understand that the end hire is the NHS, we have a little bit more of a less risk averse process than what we would if the end hirer was a private sector client, because of obviously the public sector's it's basically self risk in terms of the funds coming through the supply chain. So from a trade credit perspective, we have to make sure that we're meeting our obligations to support that supply chain. But it's becoming much more and more common now with the recruitment agencies having such challenges on that cash flow and that working capital that we're noticing a lot of umbrella companies now, a part of the agreements is to increase working capital and take the brunt of the payment terms that are passed down the supply chain. In terms of debt finance, this is something that Giant Finance Plus are able to support with. So if you're a new startup agency, if you're a small agency, if you want to get support with any financial support with clients, but maybe don't have the best credit rating, whether you're new, whether you've just gone through a bit of challenging time and couldn't really get any level of insurance on the trade credit side, Giant Finance Plus also offer, like Alison and Chris have mentioned, we also provide debt finance as well. And this allows us to be able to look at further up the supply chain to who your end hirers or your end clients are, which allows us to take credit insurance out directly on the end hirer, which allows for greater credit to be applied for, which supports that agency in the supply chain not taking the brunt or not even being able to get insurance on themselves. So I think from a Giant perspective, we can support agencies with trade credit and have been seeing an increase in that over the past 12-18 months. With debt finance, Alison's team and Alison's business, Giant Finance Plus, are the department and the team that are able to support clients and agencies where we can take out greater levels of insurance further up the supply chain. I think I want to, for those that are on the webinar, for that people who may be in compliance or in financial roles, I think it's important as well to look at the topic in terms of uninsured debt and who the suppliers are that you're getting these payment terms or these credit terms from. Do they allow that across the group? Are they using payment terms of a leverage to get on a number of preferred supplier lists? And if they aren't insuring the debt, if another commercial term that they have in place with a number of other agencies potentially has issues, if that supply chain has issues, could that have a knock-on impact to the relationship that you've got? And I think it's important, reflecting back on Alison's point, is that, you know, we don't just need to be looking at the here and now and the today and the tomorrow where the economic challenges are, but is that business and that supply chain able to support you in the next 6, 12, 18 months, because the economy will change and also the attitude to risk will change in terms of costs. So you need to be in a position where it's great leveraging payment terms further down the supply chain. It's great having that increased working capital if suppliers are able to provide that. But is that debt insured? Is that debt properly backed up by strong financial, balance sheet and a financial stable business? As Chris has mentioned during the background of this webinar, we've seen a number of financial challenges over the past few years. Recently with Buckingham Group and Wilco, and for those that have been in this sector or the industry for a couple of years, back in the few years ago, we had challenges with the likes of Carillion Group. So yes, it's great when you can, as a business, reduce your cash flow challenges and increase your working capital, but you have to understand, is that a quick win and is that a short-term gain? We've got to look at forward, businesses, owners and business CEOs and CFOs, they look at 3 and 5 year plans. There's got to be that forward thinking attitude to risk. It's imperative as a business owner or within finance or compliance that you fully understand where your money goes throughout the supply chain. And if you're leveraging third-party suppliers to make payments to contractors, freelancers, how financially stable are they as a business? If that debt is not being insured, whether that be through trade credit or whether that be through debt finance. I think just touching on how Giant can help, because I think it's important that we give a little bit of context around what we see in the marketplace, but also a little bit about how Giant can help. So we can help any agency with trade credit. We have a process where we will work with a recruitment business, and depending on the credit rating and our ability to obtain credit insurance on you as an agency, we can work with you to get as much information, whether that be a set of financial accounts or management accounts, to be able to look and secure a limit of what payment terms are required. And this means we're able to work with you and our insurers to potentially increase the limit for future growth, which mirrors your future plans within the business. So if you are an agency on the webinar today and you don't take advantage of any trade credit with Giant, then please do reach out to Chris, Alison, or myself after the webinar, and we can talk to you a little bit more in detail about how that would work. In terms of how we can also support agencies on the call with providing maybe invoice finance, and this is on your end clients or end hirers. And Giant Finance Plus provides invoice finance, which, as Alison and Chris have mentioned, is a popular finance tool for recruiting businesses. Given the need that you'd likely pay workers a week in arrears, the average time to pay UK businesses is 45 to 50 days on average. So it's really grown significantly, probably over the last 12, 18 months, 2 years, in the need for trying to support that cash flow and leveraging the end hirer invoice finance option. And I think just to mirror what Alison's mentioned in her area is that invoice financiers love recruitment sector because of the security. The invoices and timesheets have got strong backups and timesheet portals, so it's a very lucrative area for invoice financiers. And again, I suppose just to mirror the sort of part that Alison's mentioned is that in reality, a balanced combination of trade credit and finance is the most lucrative way for businesses to have a strong cash flow position and stay financially secure, not just for today, but more importantly, businesses don't want to just get by day to day. There's usually 3 or 5 year plans, and you've got to make sure that you've got them mirrored strategic partners across both invoice finance and trade credit to be able to help you grow and scale successfully. So yeah, a little bit there from me regarding the different options on trade credit and debt finance. Also, just a little bit of input on your uninsured debt through the supply chain, and a little bit on how we can help here as a business at Giant Group. Goes over to you, Betty.
Hiya, I hope you've all found this really useful today. We've just had a few questions come in throughout the session, so I'm just going to start to pose those to our experts. So the first question we've had come through today was, what are the main barriers you encounter when applying for trade credit for a client?
Okay, I'll take that one, Betty. I think the main barrier, what we look at with trade credit, and Michael's obviously already kind of gone over the process, but again, importantly with trade credit is that we're ensuring one step up the chain, which is with the recruitment business, the employment business typically. So where we find the greatest number of challenges is at this particular step one. So we'll have a conversation around the supply of trade credit and obviously commercially how that'll look, be that an increase in the margin that we charge or how we'll structure that in terms of offering it as an add-on. And then we'll go behind the scenes and we'll do an initial soft credit search through our finance team. And typically at the moment, we're seeing a knockback rate of anywhere between maybe 50 to 60%. And that's going to be primarily due to one reason, which is that trade credit, as Alison eloquently put, is a much cheaper and short-term option that the agencies are looking at currently. And they usually look at that as option number one, which unfortunately, given that most recruitment businesses' value is built into their intellectual property, makes it difficult for us to typically secure a lending limit against to insure ourselves within the chain for businesses that are probably younger than 5 years. There are obviously examples of that not being the case, and that's not a hard rule, but that is as an estimated overview. So that's really the main barrier and challenge at the minute that we find with trade credit. And I think there are a number of points, Alison, that can be considered around that and how the partners on the call today can look to improve.
Yeah, and I think one thing I would add to that, Chris, is that, that certainly is a point. What we found is that insurers are very amenable to looking at information other than that's kind of posted on the credit reference agencies. So when someone asks you for management accounts, it's a really good thing to provide them if you can, because that can help. And credit insurers will talk to the people that you're talking to as well, that you want to provide credit with. So actually kind of having that open dialogue can really help that, because financial information is by definition generally a year old. So it's really good to have those conversations. So that's one thing that I would recommend after working with the insurers for a fair time.
Thank you both. The second question that we've had come through is, are there any examples you can provide in relation to contractual disputes for trade credit or financing cash flow?
I suppose that's probably mine. I think financing cash flow works. And invoice finance works if you have no disputes and it flows through, and you try and get as much insurance through your invoice financier so that you're covered, so you have certainty of trade. The problems come is when you do have disputes, because as I said, credit insurance doesn't cover disputes. So paperwork is really critical. One main thing I would say, if there was anything, is just making sure that you know who you're dealing with. There's so many different people that trade under trading names at the moment, and if you even look at a website, it's hard to see who actually is the company behind it. So always get the company number. We've had examples where people think they're trading with somebody and they've got insurance on that party, and then when they realise they haven't, they're actually not covered. So that's one thing. So just be really, really clear about who you're dealing with, and make sure it's on all of the paperwork, or try and use online in order to make sure you've got those signed terms and that you know who you're dealing with.
Okay, perfect. Thank you for that. And then the next question that we've got come through is, how do we get more information on how Giant can improve working capital? And is there a limit or maximum amount of trade credit that Giant can provide?
Thanks, Betty. I think I'll pick that one up. So I think we've mentioned across a number of points that Giant have got a number of commercial opportunities with recruitment businesses with regards to providing trade credit. In terms of, is there a maximum limit or a minimum? I think that all comes down to the business we're engaging with. Like I mentioned on my sort of agenda topic, we will work together with that business to understand how financially stable that business is in terms of credit reports, and understand what expectations they're looking for. We can have payment terms for 7 days or up to 45 days, which can obviously be a huge relief for that recruitment business should they have further 60 or 90-day payment terms with their clients. So if you are on the call and you are wanting to know how Giant can try and relieve some of, or most of, or part of your payment terms with your client, please do reach out to Alison, Christopher, or myself after this webinar. And we can look at what payment terms you're looking for, or what limits we can provide, and how we can help grow the business together by reducing that level of cash flow strain that you may be having at the moment, and improving your working capital position as an entity. So yeah, I think every case is individual. We don't have a one sort of outcome. It's got to be done on a case-by-case basis, and Chris, Alison and I will be delighted to have some conversations with agencies and businesses that are on the webinar today to try and understand the requirements further on that.
Thanks for that, Michael. I'm just conscious of time at this point, so we're going to wrap up for today. But thank you, Michael, Alison, Chris, thank you for your thoughts and insights. And tomorrow I'm going to follow up with an email to everyone on the call, or anyone else who's also registered with the recording. We'll also be asking for your feedback, so we'll be looking forward to hearing that. And if you want to contact any of the team, that'll be an opportunity as well. Thank you again to all of you who've joined, and we hope to hear from you very soon.
Thanks,
everyone.
Thanks, everybody. Have a good day.
Bye-bye.